Hello everyone, welcome back to our educational series. In the previous videos, we learned how to read the market step by step, but that raises an important question. If we know the direction of the market and the time frame context, where exactly should we expect price to react or be drawn to? The answer often comes to liquidity. Most traders think price moves randomly. Candles go up, candles go down, and it often feels like the market is unpredictable. But if you study price action closely, you start to see something interesting. The market doesn't move randomly. It always takes the path of least resistance to the next level, and that is usually near obvious zones, often referred to as draw-on liquidity. So the objective today is to start understanding how price really moves. Let's break it down. Starting with what liquidity means. Liquidity simply means areas where resting orders are sitting in the market. Every time traders place stop losses, breakout entries, or limit orders, they create pockets of liquidity in the market. These orders often cluster around very obvious areas on the chart. Above previous highs, below previous lows, around equal highs and equal lows, and at major support and resistance levels. Because these levels are easy to identify, many traders place their orders there. And all of those orders creates pocket of liquidity. And the market moves toward those areas because large participants need liquidity to execute their trades. So the market often pushes price towards areas where many orders exist, triggering stop losses, filling large positions, and creating the liquidity needed for the next move. One important thing to understand is that not all liquidity grabs are the same. Liquidity exists on every time frame, but the higher the time frame, the more significant it is. For example, a swing failure pattern at an all-time high on the daily or weekly chart represents a massive liquidity pool. When price sweeps that kind of liquidity, the reaction can be very strong, sometimes leading to a major reversal. But a liquidity sweep on a 4-hour or 1-hour chart is much smaller in comparison. It might only lead to a short-term reaction or a temporary pullback inside the larger trend. So, when analyzing liquidity, ask yourself, what time frame created it? How many traders are likely placing stops there? And how significant is that level in the overall market structure? Because the higher the time frame of the liquidity pool, the more weight that sweep usually carries. Now, let's see what draw-on liquidity means and a swing failure pattern. Draw-on liquidity refers to the idea that price is constantly attracted to areas where liquidity exists. In other words, the market tends to move towards zones where large clusters of orders are sitting. Those orders can include stop losses, breakout entries, limit orders, or large resting orders. Because these areas contain many orders, they provide the liquidity needed for large market participants to execute their trades. So, instead of moving randomly, price often moves from one pool of liquidity to the next. And that pull toward liquidity is what traders refer to as the draw-on liquidity. What is a swing failure pattern? A swing failure pattern happens when price briefly breaks a previous swing high or swing low, but then quickly reverses back in the opposite direction. In other words, price fails to hold beyond that level. Instead of continuing the breakout, the market rejects the level and moves the other way. This usually happens because the market is taking liquidity. A swing failure pattern has 3 steps. Price approaches a previous high or low, price briefly breaks that level, taking liquidity, and then reverses back inside the range. This move usually leaves a long wick on the candle that swept that high, or low, depending on the direction. As you can see here, we have the high, above which we had the liquidity, price came up, swept the high, and then reversed, leaving a long wick on the candle. There are several patterns of liquidity grabs. Most common are these: equal highs and equal lows, naked gaps, wickless candles, and important highs or lows as all-time high or swing lows. Let's break each one down. First one, equal highs and equal lows. When price tests the same level multiple times, traders start seeing it as a strong support or resistance level. Because of that, many traders place their stop losses just beyond that level. For example, if price forms equal highs, traders who are short will often place their stop losses above those highs. At the same time, breakout traders may place buy orders above that level, expecting the market to break out. All those orders create a liquidity pool above the equal highs. And we have 3 examples here. As you can see, we have 3 equal highs here, price goes up, takes the liquidity, and then reverses 10%. In the next one, we have multiple highs creating a lot of liquidity above them. And we can see price pushes up, takes the first batch of liquidity, reverses a little, but then goes back again and takes the last high of liquidity from here. And only after that, price reverses and goes down 14%. Same thing happens with the lows. We have equal lows here, creating a lot of liquidity underneath. Price goes down, swing failure patterns the lows, takes the liquidity, and from here reverses another 11% up. The next common liquidity grab is naked gaps. A naked gap forms when price moves quickly in one direction, leaving an inefficient area where very little trading happened. These gaps represent areas where the market moved too fast for many participants to enter or exit positions. Because of that, price often returns to those areas later to rebalance the market and fill the inefficiency. When price revisits a naked gap, it often attracts liquidity and can lead to reactions, especially if that gap aligns with other important levels like support, resistance, fibs, or VWAP. And as we can see in our examples here, price moved up aggressively with this big green candle, creating a bullish naked gap. When price pulls back, holds the 3A2 inside the gap, and from here continues the move up. Same thing for bearish gaps. Price goes down aggressively, comes back to retest the bearish gap into a fib algo 707 along with an anchored VWAP, and from here continues the move down. The third common liquidity grab is wickless candles. When you see a candle with very small or almost no wicks, it usually means the market moved very aggressively in one direction. These candles often represent areas where strong momentum happened, but also where the market may later return to rebalance liquidity. When price comes back to those areas, they can sometimes act as magnets for liquidity before the trend continues. And we have a small example here. Every time we see a wickless candle, price goes and takes the liquidity above or below it. Same thing happens here on the low. Again, wickless, price goes up, but then comes back and takes the liquidity of the wickless candle. Here we have 2 wickless candles, price comes down, takes both of them, and then continues the move. The last important liquidity grab is important highs and lows. These include levels like all-time highs, major swing lows, and previously weekly or daily highs and lows. These levels attract a huge amount of attention from traders. For example, when price approaches an all-time high, many traders expect a breakout, and they place buy orders above that level. At the same time, traders who are already short will place their stop losses above the high to protect their positions. This creates a large pool of liquidity sitting above that level. When price finally reaches that area, it pushes above the high to trigger those stops and breakout orders before deciding the next move. The same concept applies to major swing lows, where stop losses from long positions tend to sit below the level. Because those highs and lows exist on higher time frame, the liquidity sitting there is usually much larger than the liquidity formed on smaller intraday levels. That's why sweeps of all-time high or major swing lows can sometimes lead to very strong reactions in the market. Once you start identifying these areas, you'll begin to notice a pattern. Price moves toward those liquidity pools before making its real move. Let's put everything together. The market is trending bullish on the higher time frame. Price consolidates and creates equal lows. Below those lows sits liquidity. Price comes down, sweeps the liquidity, triggering the stop losses. But that sweep of liquidity happens inside a weekly naked gap, which means it has more weight and can offer a stronger reaction. Right after the sweep, the price prints a market structure break. So the sequence often looks like this: liquidity sweep, market structure break, and continuation. And as you can see, from this weekly naked gap, price moved up 93%. This is how you don't FOMO into trades. Instead of chasing price, we wait for the liquidity grab and let the market show us intent. So the key takeaway from today's lesson is that market doesn't move randomly. Price is constantly moving toward liquidity. Understanding where liquidity sits on the chart helps you anticipate where the market may be drawn next. And when that liquidity is taken, patterns like swing failure pattern can give you clues about whether the market is rejecting that level or preparing to move toward the next pool of liquidity. Once you start thinking in terms of draw on liquidity, the chart begins to make a lot more sense. Instead of reacting to every candle, you start asking a much important question. Where is price likely trying to go next? Practice identifying liquidity pools on your charts. Watch how price reacts when those levels are swept, and you'll begin to see these patterns appear again and again. You are simply following the logic of how the market moves. In the next video, we'll build on this by looking at Fibonacci retracements and extensions, and how they help you measure pullbacks and potential targets. So make sure you are subscribed, and I'll see you next Friday. Bye bye!